what I want to do now is go ahead and start with the quiz from Chapter 4. Remember I said last time we would get into the quiz for Chapter 4, so that's what we're going to start with, and then we'll go ahead and pick up with the Chapter 4B, right? We have a 4A, 4B. One side is the revenue side. We'll pick up the expenditure side of our transactions here when we get into quote-unquote 4B or Part 2, however you want to phrase that. Okay, so we've broken Chapter 4 into two pieces, A and B, and this was the quiz for the revenue recognition side that, again, you would have downloaded off of iLearn. Okay, and I think we started this the other day, didn't we? Didn't we start it? How far did we get? Does anybody remember? Or you want to go back over all of them? I'm going to assume that if you're not saying you want to go over all of them, that means you don't want to go over all of them because you don't want to. Huh? We went over the whole quiz? We did? I don't need any practice, guys. I've done them already. We already did them. I don't need to do them again. So what do you want to do? Start over? Okay. Okay. All right, so let's go ahead and go back through these. Okay, let me just go ahead and get my pen back. Okay. Okay, good. So let's go ahead and let's take a look. And we're talking about what? The accrual basis of accounting, and we're talking about an imposed non-exchange revenue, such as a fine. Okay, and with a fine, we said what? Government has to pretty much have a legally enforceable claim to take that revenue. And remember, we had that one particular slide where we showed the situation where the person was still disputing the ticket or something, and they didn't take the revenue until what? The person had finally given up and gone ahead and paid the ticket. Okay, paying the ticket is a good sign that the person agrees that you have a legally enforceable claim. So even if they haven't been adjudicated liable, you can take it if they pay you. If they're challenging, then you have to wait for the outcome as the due process works its way through, right? Okay, so, and I think I gave the example. Did I give the example in here, the Forest Service and the fires? No? Sometimes I forget where I've given the example. I think I did it in Friday's class. I was on an audit where we were looking at the U.S. Forest Service, and they have this issue in which sometimes if somebody has what they call a controlled burn on their property, okay, so I have a bunch of weeds or something that I want to get rid of. Often what the person will do is they'll just burn the weeds and burn them off of there, right? Well, every now and then that controlled burn does what? Gets out of control and jumps and ends up burning good forest, okay? So now the government, the federal government, is out some money because they could have done what? They could have sold that section of lumber of a forest to a lumberjack or whatever, and then that lumberjack has to pay the federal government, and then they sell that wood to whoever wants to purchase lumber from them, right? Okay, and so what happens? The government's out money. So what do? They will send a bill to whoever they believe set that fire, right? Well, the person who set the fire often will say, hey, it wasn't me. It had nothing to do with me, right? So there's a challenge there, isn't there? Well, what Forest Service was doing is they were booking those as receivables in revenue before they had a legally enforceable claim, right? So we asked them, hey, you can book the receivable, but you're going to have to take an unearned revenue because you don't have a legally enforceable claim yet on that. So that's an example of you have to have a legally enforceable claim to take the revenue. Okay? Okay, good. Now we come over and we talk about number 2 here, and we say that under our modified accrual basis of accounting, imposed non-exchange fines and fees, such as fines, should be recognized. And notice here, guys, the answer is exactly the same, except we have now added what? And we're calling out 60 days here, okay, is the typical rule of thumb that we'll use. I'm going to have to be a little bit more careful about making sure that I'm calling out the time period, because I think for some of these questions there's an assumption of 60 days rather than calling it out. And now that I've conditioned you to realize that it's not always 60 days, we're not going to use that as a rule of, we're not going to just assume that anymore. We're going to have to what? We're going to have to tell you how many days, right? 60, 30, whatever it is, right? Okay, but remember, we add that collectability period into our consideration of modified accrual revenue, right? Okay, we don't deal with that with full accrual. Okay, let's take a look at number 3 here. And here we say for number 3, under the modified accrual basis of accounting, license fees, permits, and other miscellaneous revenue, pretty much take those when the cash is received. Okay, it's pretty much the easiest way to do that. And that somebody comes in and they need their driver's license and they have to pay the driver's license fee. We're not going to know whether or not those people are coming in until they what? Come in, pay their fee, get their driver's license, right? So when we're dealing with those sort of things and there's sort of an exchange type process going on there, we will consider that as revenue when the cash is received. Okay. Okay. Now this question and the one after it are actually probably pretty good questions. Let me see if I can get this a little better on the screen, though. If I can squeeze it down a little bit. There, that's a little better. Okay, and let's just go ahead and let's take a look at this one as a good example of a question. You could probably expect to see something like this on your midterm, okay? And, oh, come on. Let me close that. Mouse seems to want to touch everything but what I want it to. Okay, so let's just go ahead and let's take a look. And we say that a city has a 12/31 fiscal year end and adopted a policy of recognizing the maximum amount of property tax revenue allowed under GAAP. Property taxes of $720,000, of which 10% are estimated to be uncollectible, are levied in October 2013 to finance activities of fiscal year what? 2014. Now notice they end up asking me here now for fiscal year ended what? 2014, what amount should be recognized as property taxes for the levy in 2013? So we mail the tax bills out in what? That's what we mean by levy. We mail it out in 2013, but it is to finance what? 2014 activities, right? Right? Okay. And so then we come down and what? In 2015, the following amounts related to the 2013 levy were collected, and we have 2015 of January, 30,000, 2015 of March, 6,000. Now remember, when we're using our modified accrual, we have our full accrual, right? How do I know I'm supposed to be using full accrual? Government-wide financial statements, right? So I know I have to use what? Full accrual accounting, and remember it is eligibility and time, right? Okay, with property taxes, did the government have to ask itself if it's eligible? Does not have to ask itself if it's eligible, so I just need to worry about time. And for property taxes, for imposed non-exchange revenue like property taxes, we said what? We said that we simply have to have use is able to begin, right? And the use is able to begin in 2014 in this example, right? It's for 2014 activities. So what happens? For 2014, we can take the entire amount less the uncollectible, right? Remember, we take that net of the uncollectible amount. Okay, so we would have sat there and debited our taxes receivable for how much? 720,000, right? We would have credited revenue for what? 648. What's the 648,000? What's the credit? What's the rest of this credit to? What do we got? How much is the additional amount we need here? 720 minus 648. 72,000. Okay. 10%. Hello, John. Okay. So what do you want to credit? What? The allowance, right? For uncollectible taxes? Hello? Okay. Okay, good. So we go ahead and we credit the allowance here for 72,000, right? Now, that's for 2014, right? We can take that revenue. Okay, but that's sort of assuming that we mailed the tax bills out in 2014. The problem told us that we mailed the tax bills out in what year? 2013. So what we would do in 2013 actually is go ahead and debit the taxes receivable. Now I have to squeeze the correct entry in over here. Debit the tax receivable for what? 720? This is in 2013 when we mail out the tax bills. Right? Credit what? The allowance for the amount that's not going to be collectible, which is how much? 72,000. And for the portion that I think is collectible, I need to credit what? No, we don't call it unearned. We can call it deferred inflow because what? We don't have to ask ourselves about eligibility for property taxes, but we haven't met the time requirement because we're still in 2013, aren't we? Right? Since we're still sitting here in 2013, we go ahead and we debit the credit the deferred inflow for those amounts that we're not going to collect. Now in 2014, when we actually go ahead, so let me erase this one because actually I did this journal entry assuming that we were mailing the tax bills out in the same year we were going to collect them. No, 2013. We do this when we mail out the tax bills. 2014, what we should do is what? Can use begin now? Can use begin in 2014? Use can begin in 2014. So in 2014, we do what? Debit the deferred inflow for what? 648,000? And credit the revenue, right? For 648,000 because use may begin now, right? Right? Okay. Now what happens? Let's say in 2013 somebody pays their tax bill early. We mailed the bills out in October, didn't we? We mailed the tax bills out early in 2013. Let's say somebody pays their bill in November 2013, or they paid in December 2013 because they want to get a tax deduction, right, for their taxes. So what journal entry should I make when someone sends me money in 2013? Debit cash, good. Let's say they send me 12,000. I'm just making that number up. Okay, what do you want me to credit? Huh? Taxes receivable. What do you credit when you get money that you set up a receivable for, right? Right? In 2013 when someone sends me money? Okay, what do I do in 2014 when somebody sends me money? Same thing. Say they send me now another 12,000 in 2014, debit cash, credit what? Taxes receivable. Now, by then, I've taken the revenue because I've met the time requirement. Use may begin, so I've taken the revenue on that, right? Okay. Okay. So let's come over and let's take a look now at this next question, number 5. Question? Question? Okay. Okay, good. So we look at number 5. And we say a city, and it's the same fact pattern, 12/31 fiscal year end, adopted a policy of recognizing the maximum amount of real property tax allowable by GAAP, and property taxes of 720,000, 10% is not estimated to be uncollectible, are levied in October 2013 to finance the activities of the fiscal year 2014. During 2014, cash collections related to property taxes were 600,000, and then what? In 2015, we got what? 30,000 in January, 6,000 in March, right? And now they ask me what revenue should I recognize in what? In 2014, but they're asking me at the governmental fund level, so they're asking me modified accrual. Same fact pattern, now we're on modified accrual, aren't we? Okay, so let's go through the same scenario here now. And I'm going to go ahead and just erase this to give me some room here. Anytime you want to erase, that's fine. Anytime Microsoft, just erase, that'll be fine. Anytime you want to just go ahead and erase that, let me erase that. That'd be beautiful. Thank you. Okay. Okay, now, so what happens? You should hear the things I say to my computer when nobody's around, right? I'm not nearly as nice to it. Okay. All right. So anyway, I'll stop there. Okay, so what happens? In 2013, when I mail out the tax bills, what journal entry should I make? They mailed out the tax bills. They levied the taxes in 2013, didn't they? So what journal entry should I make when I mail out the tax bills at $720,000? Good. Debit taxes receivable, $720,000. Good. Am I going to collect that 10%? So I'm going to go ahead and set up the allowance for the $72,000, right? Okay, good. What journal entry should I make for the rest? For the amount I think I'm going to collect? Deferred inflow, because what? I have not met my time requirements. I don't have to worry about eligibility for property taxes. So it's $648,000. Is there any difference between the journal entry for modified accrual and accrual? No, right? Okay, it's still deferred inflow. I haven't met my time requirements, right? Okay, now what happens? Now I get into 2014, and in 2014 now we do what? We have to worry about the collectability, don't we? If we're going to get that money within 60 days. Right? So as a practical matter, what the government does is each time they collect the revenue, they just go ahead and take it, and then by the time they get to the end of the year, they're going to have to estimate what additional amounts will they collect within 60 days, and if they're not going to collect it within 60 days, it's not a revenue of 2014, right? Okay, so how much did they actually collect? $600,000 during the year, so they're going to debit what? Cash, $600,000. Credit the taxes receivable, what, 600,000? Because they've collected those. Okay. And we're going to do what? Debit deferred inflow. For how much? 60,000 and not 60,000, 600,000. 600,000 in credit what? Revenue for 600,000. With me so far? Okay. What about this 30,000 that they collect in January? Can I take a revenue for that? Yeah. I can take that, even though they're collecting in 2015 now. I go ahead and what? I'm going to, and for my 2014 statements, I would debit deferred inflow for how much? 30,000 and credit what? Revenue for 30,000, and I'm doing that in my 2014 statements. Now you say, well, wait a minute, John. They don't know if they have that 30,000 at the end of December 31st, 2014, but by the time they're preparing the financial statements, they do, don't they? Right? Because they're preparing the statements, and in some senses they'll say, well, what if they don't know? Well, then they'd have to estimate, wouldn't they? But they would have to figure out how much they think they're going to collect within the 60 days of, if we were using 60-day criteria, within the 60 days of 2014, right? Of which 30,000 coming in January 2015 would qualify. How about the March amount? March amount is not going to meet the 60 days, right? So what's going to happen? In 2015 now. I guess I'll write 2015 up here. In 2015, is more cash going to come in? So I'm going to debit cash for what? 30,000? Well, no, I got to get the cash for 30,000 first, guys. Let me get that first. That's in January. The cash for 30,000. I'm going to credit taxes receivable for 30,000. I don't have to take any revenue now because I've already taken the revenue in 2014, didn't I? Right? Right? I already took that in 2014, so I don't have to worry about the revenue. What do you want me to do with this 6,000 now in March? I'm going to debit cash, right, for the 6,000. I'm going to credit taxes receivable for the 6,000. With me so far? And now I can do what? Debit deferred inflow for the remaining, well, not the remaining, but this additional 6,000 in credit revenue, right, for 6,000? Debit deferred inflow credit revenue for that 6,000. That's what year's revenue? 2015 revenue, isn't it? That's 2015 revenue because it got outside of the 60 day, and I'm assuming 60 days here. It got outside of the 60 days, didn't it? So that's a revenue of 2015, not 2014. Debit deferred inflow for 6,000, credit revenue for 6,000. Debit deferred inflow for 6,000, credit revenue for what? 6,000. That's for that revenue that fell outside of the 60 days, right? And it's revenue of 2015. Okay? And I'll just keep going like that. If I continue to collect the remainder of that 648,000 in 2015, that's revenue of 2015. If in some weird situation there's a delay and it starts to do what? It starts to go to 2016 March, then that's 2016 money, isn't it? Okay.
That 60 days rule applies like a technically exactly 60 days, or we think that monthly basis, every month 30 days?
60 days if the government has established that as their accounting policy. I mean, we shouldn't change our accounting policies from period to period. So once they've picked 60 days for certain types of revenues like property taxes, for example, then they should use 60 days consistently. Okay? Question? So the answer to this question is what? 630 is what they take as revenue. The 600 that the money that they collect within 60 days. The 600 that they collected during the year, and the 30,000 that they got in January, right? Not the 6,000 in March. Okay? Eligibility and time for both, right? Full accrual and accrual. Measurable and available, though, we add that on to our modified accrual, and available means probably we're going to stick with 60 days, guys. Again, I sound wishy-washy on it because it's not a hard and fast, right? Okay? All right, good. Let's take a look at this one now. And a city has a 12/31 fiscal year end, has adopted a policy of recognizing property tax revenue consistent with and it's not a 60-day rule. It's a guideline, and it's something that I think it's the GFOA is the one that talks about that. So there's no 60-day rule in GAAP. They should not say that. Okay. I don't like that. But anyway, property taxes of $600,000. None are estimated to be uncollectible, are levied in October 2013 to finance the activities this fiscal year 2014. Property taxes are due in 2 installments, June 30th, December 20th. Cash collections related to property taxes are as follows. Okay, all this is useless. This whole set of information up here helps not at all. Okay, so you start sitting here and you start looking at this and you look at this table and we say 115.14 property taxes levied in 2012 due in 2013. That was due in 2013. Did we get it within 60 days of 2013? So did we meet our what? And I guess we need to know that we are using what type of accounting? Modified accrual accounting, right? So we better know that, right? Okay, and so this 25,000, did it get within the 60 days of 2013? Is it within the 60 days of 2013? So this is 2013 money. This is not the place for cell phones. So that's 2013, right? Okay. Okay, good. Then what happens? Then we come over and we have the what? Amounts from 20 levied in 2012, due in 2013. Did they get within the 60 days of 13? So that's 13 money. So I'm not going to count either of those as 14 money, even though they collected them 14 money because they were within 60 days of the 13, and the bills were levied in what? 12. Okay. Okay, good. Then you come over and we have this 315.14 for property taxes levied in 2012, due in 2013. But what happened? They fell beyond the 60 days, didn't they? So I got to take that 10,000, don't I, as 2014 money? Okay. Okay, good. Then what? Then I get this 620 2014, and it was what? It was the amount that was levied that we heard about up there in 2013 that was due in 2014. So that's clearly what? 2014 money. Same thing with the second installment, right? Okay. All right, that's what I'm saying. The information up there is useless because you could have figured it out from this table, right? Okay. Then what? Then we say that we've got an amount in January 2015 for the amounts levied in 13 that was due in 14. I'm going to pick that 15,000 up, right? Same thing with the 10 because it's still within the 60 days, not the 5, because the 5 is 15 money, right? Because it got outside the 60 days. Okay. What if oh, that's what they did here. Is that what they did? Let me see. Yeah, same facts, right? Same facts, but now it is going to be the government wide, so we're going to use what? Full accrual amounts, right? Full accrual statements. And so they did what? They levied property taxes of how much? 600,000. They don't say that anything is uncollectible. So whatever you levied in 2013, if use can begin in 2014, that's revenue of 2014, right? And we don't worry about the 60 days, right? And these amounts, these first couple amounts were what? These first couple amounts were, these first three, in fact, were all what? All under full accrual would have been 2013 money, right? So what's the answer? What's the answer? Huh? When I mail the tax bills out in 2013, what journal entry should I make under full accrual when I mail these tax bills out? Taxes receivable is going to get what? Debited for 600,000. What should I credit? Deferred inflow because I have not met the time requirement because it's not 2014 yet, right? For 600,000? That's 600,000? What do you want me to do in 2014? As soon as the clock strikes 12 midnight on January 1st, 2014, what do you want me to do? Debit the deferred inflow for the 600,000. Credit what? Credit the revenue for 600,000, right? Right? Let's say there's a revolution and people start saying to this government, we're not sending you any money. We're not going to send you any money. And it's not until 2015 that we, go into the people's houses and take the money from them. So we collect this money in what? In 2015. Okay? And so what should I do in 2015 when I finally bust into their homes and take the money from them? Debit what? Cash for how much? 600,000 and do what? Credit what? Taxes receivable 600,000. No, I took the revenue in 2014, didn't I? You mean taxes receivable, right? Notice no revenue in 2015, and I don't care if it was, 3 years or whatever it was until I finally got the money. I still do what? I take the revenue in 2014 because that's when use may begin. That's my time requirement. I don't worry about how long it takes me to collect it, right? Okay. All right, good. Now that won't happen, but the way I describe. Okay, let's take a look at this one now. And am I boring you guys with this? I don't need to do this. I could sit here and answer this test on my own if I had to.
Hey, you said for 2015 you record the revenue.
No, we would simply record the receipt of the cash, debit the cash, credit tax receivable for 600,000. The revenue was already taken in 2014. Okay. Okay, I'm just saying that the cash collection for the full accrual, just like it is in commercial, although we got different rules going on here, but the cash collection for our accrual accounting is not of no consequence, right? Modified accrual, we start looking to see, well, when are they going to collect that cash, right? And we start kind of going a little bit into like a cash basis type approach. That's why they call it modified accrual once we get past that 60 days, right? Okay, good. Let's take a look at this one, and we've got some sales taxes. When are you supposed to take the sales tax? Huh? Good. When the underlying transaction takes place. Very good. That's when we're supposed to take our sales tax, right? Okay, so they're going to be telling us when the underlying sale takes place, and they want to see if I know that I should take this where? Into my 2014 revenue for what kind of fund? Governmental fund. So I'm using what type of accounting? Modified accrual, right? Okay. Okay, good. So I've got what? Amount received 120 2014 applicable to 2013 sales. Is that 14 money? Why? It's applicable to 2013 sales. I take the revenue when the underlying sale takes place, don't I? And since they collected that within 60 days of the year in which the underlying sale takes place, that's 2013 money, right? Right? Okay. Okay, good. Amount received to 2014 applicable to January 2014 sales. Is that 14 money? Yes, it is. That's 14 money, so I'm going to grab that one. Okay, good. Now what? Amounts received during 2014 related to February through 2014, November 2014 sales. Well, that's all clearly what? 2014 money. I don't even have to hardly even think on that one. How about amount received 2015 for December 2014 sales? That's 2014 because I got within what? It related to when the underlying sale took place in 2014. I'm still 60 days within, right? How about this amount January 2015 for 2015 sales? That's good. That's 15 money, right? Okay, good. So you add these up, and what's that? 540, I guess? Am I doing my math right? Good. Okay. Okay, good. What's this one? Same thing, government-wide. Same thing, government-wide, so it's simply when the underlying transaction takes place, and I don't need to worry about this 60 days, right? Okay, just the theory I have, okay, I'm going to stick with this theory, that if you open your eyes and you leave them open, it's easier to understand the material. I'm just thinking, okay? Now, I know I have a face for radio, but, you might as well take advantage of the full amount of faculties you have here. Both vision and audio are good. Okay? Okay, so what happens? We're sitting here and we have what? We have amount received on 1/2014 applicable to 13 sales. Is that 2014 money?
Yes.
How? On what planet?
Oh no.
The sales took place what, in 2013. You're like in a planet where you don't have crazy governmental accounting rules. That's where, John. Okay, but what? We're sitting here and that is what? That is 2013 because the sales took place in 2013. And for full accrual, we don't care about when it's collected, right? Okay, so how about amounts received 2014 applicable to 2014 sales? Yep, we're going to pick that 30,000 up, right? How about the amounts applicable to the 2014 sales through November? Yep, got to pick that one up, 400,000. How about the amounts collected in 2014 related to 2014 sales? Collected in 2015, I should say, related to 2014 sales. We should have taken that in 2014, right? Okay, and this other one was 2015 money. So it so happens, using different rules, you get what? You get the same answer. And the reason you get the same answer is that everything for 2014 got collected within 60 days in 2014. Otherwise, we would have gotten a different answer, right? Okay. Okay, good. Let's take a look at this one. This one's a little bit funky, this number 10. But let's go ahead and let's take a look at it. During 2014, the city issued $300 in fines for failure to keep property taxes in acceptable condition. During the period, the city spent $200 to mow and clean up unoccupied properties for which the fines were assessed. This is irrelevant. This is just here to give you another set of facts to worry about that you don't need to worry about. The city estimates that $30 of the fine issued in 2014 will be uncollectible. During 2014, the city collects $230 related to the 2014 fines. If the person pays a fine, are they still disputing it? No, they're paying it. They're saying, hey, I give, right? Okay. Then what? And there's 20,000 related to 2013 fines. Well, why didn't they pay that money in 2013? Who was $20 short? The person who owed the money? Okay, well, I'm kind of thinking that they might have been saying, I don't owe you that money, I'm sure. And finally, they were convinced that, yes, they do, right? When finally they said, you're out of your appeals or whatever. Okay, and so that money, we had a legally forcible claim when? In 2014, didn't we? If the person's paying us. Okay, and so what amount should I recognize? It's what? 250. It's pretty much, and in my governmental fund financial statements, it's pretty much what? What I have collected, because what? Because if people are paying me, that means that they're saying that they owe me the money. Okay. Okay, good. A city receives a notice of a $150,000 grant from the state to purchase vans to transport physically challenged individuals. Although the city did not receive any of the grant funds during the current year, the city purchased a bus for $65,000 and a van for $60,000. The grant revenue that should be recognized in the government-wide financial statements is, okay, now you see the answer there, but let's think through this. They tell me that I have a grant coming, don't they? They said you've been awarded a grant. Do we see any eligibility requirements? If they award me the grant, is there a contingency as to an eligibility? No, we know we're eligible because they told us we got the grant, right? Do they say anywhere to us that I have to use the money in any particular year? No, they say, hey, you got this money, you can purchase the vans whenever. You can purchase them immediately, you can purchase them next year, the year after that, etc. So there's no time and there's no eligibility, right? So what am I going to do? I'm going to debit my, I guess now it's not taxes, but what? Grant receivable. for what? 150,000? And I'm going to credit what? Revenue for 150,000 because they told me, "Hey, go for it, man. Start buying vans and buses because, you've got this grant coming, don't you?" Right? Okay. Okay, good. Now what happens? Now so it's 150,000, okay? Now this one is a little bit tricky. They say last year I received the notice of 150,000 and this year I started spending the money, what should be the grant revenue? Well, if I received the notice last year, that's last year's money, right? Even if I don't get around to spending it until this year, when I spend the money is of no consequence, right? Right?
Yeah.
Okay. So there it would be 0. Okay. Question? Okay, good. Number 13, Paul City received payment of 2 grants from the state during the fiscal year ending September 30th, 2013. Grant A can be used to cover any operating expenses incurred during fiscal 2014. Is that a time requirement? Here we go, the time requirement. Grant B can be used anytime to acquire equipment. That is no time requirement on that, right? Okay, so what happens? How should we report these in 2013? Well, we've got grant revenue for the one that they said we can pretty much use it any time, right? Not pretty much. They said we could use it anytime. So that one's revenue over here. Grant A, because they put a time requirement, I can't use that until what? 14. That's a time requirement, so that's a deferred inflow. Okay. Reimbursement type grant is recognized in the accounting period in which what? The expenditures are made. Go back to that example of these buses or whatever that we were buying. How much was it? 60 and 65,000. What would happen if they said, "Hey, you can buy buses and vans, whatever this for this disabled program, whatever, up to 150,000." They tell me that, and they said we will reimburse you for any money you spend up to 150,000, right? So, and that's the case, then they have to do what? They have to spend the money to be reimbursed, don't they? Okay, so now our eligibility is actually spending the money, right? Now, do we want to lose track of that grant receivable? Do we want to put nothing down for the grant receivable? Or do we want to set up the grant receivable so we know, hey, we got 150? Isn't that why we have accounting? So that when people say, hey, we owe you money, we can keep track of it and say, hey, where is it? We want to make sure we know how much we got coming, don't we? Okay, so what am I going to do at the time that they tell me you have 150,000? You will be reimbursed for this 150,000 when you spend the money. Good. I keep wanting to say taxes receivable. So I'm going to debit what? Grant receivable? Grant receivable for what was it? 150,000? And credit what? Well, have I met eligibility? I have. I have to spend the money to be eligible, don't I? So since I haven't met eligibility, but you're on the right track, I have to debit what? Credit what? Unearned revenue because what? Because I haven't met eligibility and I can't call it deferred revenue. I can't use the D word, but it's a liability, right? What if I don't buy one van? What do I have to do? If I don't buy any vans, I say, "Oh, forget that program. We don't have we don't have the money to keep up the buses. We're not going to be able to do that because we don't have the money to keep up the buses. We can't pay for the gas." What do we do? What will we have to do? reverse the entry because we're not going to do the program, right? We're not going to meet their requirements, so we just say, oh, well, that's not receivable for us anymore, right? And reverse that entry. Okay, good. So what happens? Now I go ahead and I do what? I meet their requirement. I buy the buses, don't I, or whatever these things were? So what was it, 125,000? For those two?
125.
125? Okay, good. So I'm going to do what? I'm going to debit expenditure. $125,000 because I bought those vans. Credit what? Cash. 125,000 with me so far? Okay. Now what do I do? Have I met the requirement? Okay, so I'm going to debit the unearned. And what? There was no time requirement, but now I've met eligibility, so I can do what? Take that as revenue, 125,000, right? So I bought the two vans, 125,000. Let's say I sit around there for a while, and I finally determine, we got enough buses and vans, we're not going to buy any more buses and vans. That's it. What do we do at that point? Reverse for what's left. I'm going to do what? Debit the unearned for 25,000 and credit what? Grant receivable for 25,000 because I really don't have a grant receivable anymore because I basically telling them I don't want any more of their dirty money or whatever, right? I'm done with it. Okay, Caesar.
This is kind of just a question. Could they argue to keep the 25,000 for like upkeep? It's up to you.
Um, if the law somehow said they could use it for upkeep after they had expended certain amounts, or there was a change in the law, something like that, but there would have to be a change in the laws or at least in the administrative requirements of that program to say, hey, here's what it's for. So if Congress said this money needs to be used for disabled programs, generally, and then the agency said, well, for this year we're going to have it all be for bus actual purchases of equipment, actual acquiring equipment, and for that year it is, but then later they say any amounts that are left over that weren't used for equipment may now be used, assuming you had spent X percent of the grant for the buses. If there's a change in the requirements administratively or legislatively, then yes. Okay, we could argue that, and we could win the argument, right? And they could either administratively or uh, or or legislatively change the requirements. Okay, um, this is why I'm of the opinion that because they have this COPS program. Remember the COPS program I told you about where state and local governments can receive a grant from the federal government and they can use that money for police officers' salaries and uniforms, that kind of stuff as an operating grant, or what, to purchase equipment as a capital grant, right? If I was president, now I'm going to run for president here. If I was president, what I would do is I would say, okay, what we're going to do is under that program where you can use the money for equipment, for 1 year, governments that apply under that program for a capital grant must use the money to buy body cameras for police officers. Now the federal government, and you don't even have to go back and say, hey, legislature, is it okay if we do this? Because the legislature said it can be used for what? For equipment, and all you have to do is say, okay, the equipment that we're going to allow, that we're going to approve for 1 year is body cameras, and you could go a long way towards settling the issue of where are we going to get the money for body cameras, right? There it is. That money's already appropriated for that program. You're simply doing what? Earmarking it and said it has to be spent on a specific type of equipment, right? Now, what a lot of the police stations, police departments argue is they say, well, we can't be inundated with requests for the actual feed on those cameras. Well, that's why God invented the internet. I mean, you can load the whole world on YouTube, right? But now we don't have the ability to load those body camera feeds onto some sort of website where people can go and just download it and take a look at it, and it's there, isn't it? And there's not a whole lot of cost associated with that. And if you're sitting there saying, well, we don't have the storage for that, then just say it's available for 60 days. After 60 days, if you don't get that, it's going to be deleted and purged so we can make room for the other stuff, right? Okay, so there's ways around a lot of the things that they just want to sit there and argue about. They have the mechanisms in place, but they don't want to get to play the politics. Okay, anyway. How about this one? Is this another question? Unrestricted grant revenue with time requirements are recognized as what? Should be recognized, I think we mean as revenue, when what? In the period in which the grant is required to be used. That's a time requirement, isn't it? Okay, good. Let's take a look at this one. General fund levies property taxes in the amount of $1 million. It expects to collect $950,000 during the year, $30,000 in the first 60 days of the next year, and $15,000 during the rest of the next year. And we need to be more careful to call out that that's how many days requirement are we using here? 60 days. Okay, I'll make sure the problems say that. So this one's a piece of cake for you guys, isn't it? Compared to some of those other ones. We set up the taxes receivable. We set up the revenue, and the amounts that are falling outside of the 60 days is what? Deferred inflow, right? Okay, so that amount is revenue. What happens if I'm asking you the government-wide? Huh? Just 950, you say? I have no idea where you're getting 950 from. Help me. Where are you getting 950 from? Oh, the amount it expects to collect? Really? That's how you do it under modified accrual? I mean under full accrual, the government-wide level? Huh? Are we going to recognize the amount that we're not going to collect under full accrual? Do you recognize as revenue amounts that you're not going to collect under full accrual? No. Okay. 995. Yes. 995, right? The amount that's going to go outside of the 60 days is not relevant, right? So I don't know why I'm doing that. It's 9 what? 995, right? Okay. Okay, good. A city levies property taxes $1,050,000, but believes it will not be able to collect $50,000. What entry should we make? Well, if we're not going to collect, we set up an allowance for the amount we're not going to collect, and we reduce the revenue by the amount we're not going to collect. Notice here, I did not call out whether it was the government-wide or the fund financial statements because it does not matter, right? It's irrelevant. Okay, good. Which of the following is not considered to be a derived tax revenue? Remember, derived, we derive the revenue from the underlying transaction, don't we? Okay, so property taxes are not derived because it's based on the value of the property. Whereas there's an underlying transaction, the sale for sales taxes, the earning of income for income taxes, and D is not the correct answer, right? Chase City imposes a 2% tax on hotel charges. Revenue from this tax will be used to promote tourism in the city. Chase should record this tax as what type of non-exchange? It is derived because what? Somebody has to stay in the hotel, don't they? And pay for their room? in order for us to get this 2%. So it is derived from an underlying transaction, the stay at the hotel. The following information pertains to the property taxes of Oak City for 2014. And we have what? Collected taxes in 2014 related to the 2014. Expected collections for the first 60 days of 2015 are 100,000, and then they tell us expected collections during the balance of 2015, and they start giving me some amounts here. They give me the total levy, and then we're talking about what statements? Fund financial statements. So it's what I collected during the year or within 60 days. It's modified accrual, right? So it's 600,000. The 100,000 that was going to be within the first 60 days, and the 500,000 they collected during the year. Oh, can't be. That's it?
The car registration fees, are those derived?
Car registration fee is a weird category of, that's a good question. It's sort of a miscellaneous category in a way, in that what? It's kind of an exchange revenue, but we don't call it an exchange because it's hard to place a value on what you pay for your license. Is it really an exchange? We can't quite create that cause and effect. So for that sort of weird category of fees like that, we go ahead and we treat it like an exchange, but we don't call it an exchange revenue. It's just sort of fees, and it's when the amounts are collected. Okay, so it's a weird category of revenue. It's a non-exchange, but not really. It's kind of an exchange. So just treat it like an exchange, which means the service has been provided, which means what? Which means the license was given, the person paid for the license. Okay, question? Okay, we've got a little bit of a dilemma in that we're done here at with this at 20 to 5, but I've got to go open a door at 5 o'clock because I guess they think they'll trash the place unless I open the door for them, which they don't know me very well, do they? But anyway, so I'm thinking, what would that be, a 20-minute break if we try to do it? Let's go ahead. I hate to start and then stop on chapter 4. Let's go on 4B. Let's go ahead and let's start it. And what we're going to actually do for the start, save this, is we're going to, I guess I can close this now. Okay. Then just close the program if you're going to act like that. And let's go ahead and start chapter 4, and then we'll take the break at 5. Okay, so this is chapter 4. This is part 2. If you see some weird chapter numbers there on yours, that was because before I changed it, you might have downloaded it when I still had the other chapter numbers there from a previous book that I was using. I was using a different book, and the reason I used that book is because they put my name in the front of it, and then I realized this is a horrible book. Take my name out of it. No, I didn't say that to him, but it was kind of like, so this is just the part, this looks to me like just the part A you have. This is not the part 2 or part B, whatever. Okay? And so I went back to the old book, even though I didn't like that one either. And so what it's turned out is I've just gone ahead and kind of created my own set of stuff here to a certain extent. And so it should say part 2 on this. Okay? And that's on iLearn as part 2 for you. Did you get it now? Okay? All right. So let's go ahead And let's just review some things. And you may not see this because I just put this up like this yesterday, okay, which is just including some things from chapter 3 that we talked about last time, okay? So we come over, and remember we talked about our budgetary accounts, and we have what? We have our estimated revenues, right? And then we said that our other financing sources were like non-operating revenue, but we don't call them that. We call it other financing source, don't we? This is just chapter 3 stuff reviewed, okay? So we call this estimated other financing sources. We debit those when we get them because our actual revenues will be what? Credits, and we'll be able to keep track against our revenues as we go throughout the year, right? Okay? Okay, good. Then we had our appropriations, and I said that was like estimated expenditures, but we don't call it that. We call it appropriation. A government cannot spend money unless it has the legal authority to do so, right? Okay, so we have to wait for an appropriation, legal authority to spend money. We have estimated other financing uses, which we said are like non-operating expenses, but we don't call them that. We call them what? Other financing uses. So we put our resource inflows together, our estimated revenues, our estimated other financing sources. We put our resource outflows together, our appropriations, our other financing uses, right? And these are estimates, okay? The appropriation is the legal authority to spend. Now, we come over and we also had these budgetary accounts that we use during the year. One is called encumbrances. The other is budgetary control. Okay, so these were just our budgetary accounts that we talked about a little bit in chapter 3. And then we went ahead and took a look at the journal entry that we make at the beginning of the year, where this government goes ahead and does what? It debits the estimated revenue of $500,000. Is this for sure the amount of revenue they're going to get? This is just their best guess, right? They credit appropriation. That's when the legislature signs into law and the executive branch signs into law the ability of this government to spend money. If we don't have this appropriation, we have no legal authority to spend money. That's why they shut down the government a couple times, right? Because they did not pass an appropriation. They did not have the legal authority to spend money. So once we get that appropriation, we credit appropriation and we debit credit budgetary control. And when we credit this budgetary control here, this government has a surplus, right? Okay. This government has a surplus. So now what? We go ahead and we credit this surplus for budgetary control because they think they're going to have some money left over. Now notice I put over here, alternatively, we could have a deficit if the government makes a decision that it's going to spend more money than it's going to take in, right? So in this example, we only had estimated revenue of $450,000. We had appropriation of $500,000, so they chose to spend more money than they were taking in, right? They did this on purpose.
If they estimated the amount that they're gonna spend more than actually they're gonna receive, they cannot like if cannot they actually make that the lower the budget or make the smaller budget, so they're gonna spend exactly the same they're gonna receive.
They could if they wanted to, but they don't. Now I'm saying they, the federal government, okay? What happens? Federal government sits here year after year and says what? Says, well, my estimated revenue is $2 trillion. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12. $2 trillion. That's my estimated revenue. Okay? My appropriation is what? Is a legal authority to spend money. In other words, they direct people to spend. They tell them, this is the amounts that you should spend on programs like helping veterans, like helping disabled, like funding money to the states to help fund the state universities. This is the money that you should spend to help these people. If I give you money and I tell you to spend money to help people, what are you going to do with it? Spend just money to help people, right? You've got all these people, taxpayers, that they say that they love so much, the taxpayers that are so smart and always vote correctly, the American people who they love so much, right? And so what happens? They sit there and they say, okay, spend $5 trillion. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12. Spend $5 trillion. What's the difference here? 3 trillion. We need a debit, don't we? 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12. That's our budgetary control. And again, federal government doesn't use this exact account names, but the numbers are similar. This amount is a what? Deficit, isn't it? So we have a deficit of $3 trillion, right? And we do that year after year after year after year until one day you look and you have a deficit of 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12. $17 trillion, don't you? Okay? Now, what happens? To get even cuter, they do something like this. They sit here and they set a debt ceiling at, say, 19 trillion. Okay? They set a debt ceiling at 19 trillion when the debt is sitting here. They say we can't go past 19 trillion, right? And they all agree we can't go past 19 trillion. Everybody says, okay, we won't go past 19 trillion. That's a law. And then they sit down and they pass this law. They pass the law to spend this much money, knowing that their revenues are going to only be 2 trillion in this example, right? If when they pass that law, if they were here, are they going to exceed that debt ceiling? Yes, they are. It's going to go to what? 20 trillion. And so at that point, 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12. So at that point, they'll stand there and they'll make a speech to you about how wrong it is that we're going to exceed this debt ceiling. This is terrible. We can't do this. Meanwhile, this same guy voted for this when the debt was this. This person should have to explain themselves, shouldn't they? But they never do. Now, you said to me, well, can't they make this smaller?
Or like they know they're gonna have a budget like 2 trillion.
They know they're going to have a revenue of 2 trillion.
Spend it 2 trillion. No more.
Okay, so I got it. I know how they can do it. Cut out all help to the states. The federal government should not give any more help to the states. That sound you hear, you think your tuition's bad now? Do you want to vote for me for president? I'm going to say, oh, I got it. We're cutting all money to the states. That's how we're going to balance the budget. Are you going to vote for me? You are? Well, thank you. Okay, most people would say, that guy's insane. He's crazy. What do you think of that crazy idea? That's terrible. You know they're going to triple your tuition at the university here, right? As a matter of that, are you okay with that? No, don't vote for that guy. By the time you get home, you'll be drawing up signs to have me thrown in jail. You'll be...
Unlike Trump.
Huh?
At least you're honest, unlike Trump. He says many things, but he's not going to make it.
Well, that's okay. But my only point is, I don't want to get into that. I agree with you, but I don't want to say that I agree with you. But what's happening? My point is what? Nobody will vote for somebody that cuts this number down to what it has to be, right? Okay, so maybe we should vote for the guy who says, well, I'll increase this number. I'll just increase the revenue. How do you increase the revenue? Raise taxes. That was your buddy Bernie Sanders. He didn't get very far either now, did he? Okay, so what happens? Nobody wants to be the bad guy that's going to say, I'm going to cut this or I'm going to increase this. But they also don't want to be the bad guy that is doing what? That is causing this. So they play little games like this So you think that they're everybody. They're not the guy that raised the taxes. They're not the guy that spent the spending. And they're not the guy that caused the deficit either. That got us closer to 5. Good. Okay. All right. So we go ahead and we do what? We set this thing up like this, right? Now I'm talking back over here, right? We debit our estimated. If you're waiting for an answer, I don't have one. Because look, it's hard. It's hard because solid economic theory does say that if you raise taxes, that's going to slow down the economy, right? Right? Because you're taking money out of the system. Meanwhile, what's happening? Meanwhile, the Fed didn't raise interest rates, right? Because they're still looking at what's going on. They're saying, well, the recovery is not that great that we need to slow down things, right? And so should you really be cutting taxes right now? No. But what about fiscal policy? If we're sitting there and we're trying to hold up the economy and keep it going right now, should we really be cutting back on government spending? Probably not. Okay, and so the question becomes, maybe the problem was not the spending that we've done over the last 8 years when we've been spending money on trying to get out of that mess we were left in. Maybe the problem was the money that we spent dropping bombs in the desert, okay, for no end. Okay, stop, John. The whole thing's a mess. Okay, so what happens? And it's hard, but it's hard, right? Because maybe those people we're going to fly in more planes into World Trade Centers. Okay, so it gets hard to know what the right thing to do is. That's why it's tough to run a country. Okay, so what happens? We sit over here, we debit the estimated revenue, 500,000, we credit the appropriation for 50, and we have our budgetary control. In this case, we have a surplus, don't we? Okay, but then you come over and you say, well, John, why did you debit estimated revenue, right? Isn't that weird to debit a revenue? We debited estimated revenue. And the reason we debited estimated revenue is it sat there as a placeholder for us all year as we did what? As we credited our actual revenue, didn't we? So at any point in time, this government knew at a press of a button, well, if I've collected 40,000, and notice, guys, the actuals, just like you learned in Accounting 100, you debit the cash, you credit revenue, right? But we debited the estimated revenue. That's a budgetary account. And we go ahead and we have how much left? 460 left to go, right? You issue some more fishing licenses the next month, whatever. You debit cash, you credit revenue. That's going to be what? Now we got 410 left to go, right? So by debiting estimated revenue, it sits there as a placeholder against our actual revenue as we credit. And at any point in time, this government can tell you where they stand against the budget, right? Right? Okay. Now, when we come back from the break, we're going to talk about the appropriation and the spending side because that's where we are now. Okay. We have spent a lot of our time with revenue recognition and how we ended up with those revenues. But other than that, part of the revenue recognition, the revenue is kind of boring, isn't it? Hey, you set it up as a debit. As you collect, you go down against it, etc., right? The what? How we control our spending against our appropriation is more interesting because we have to make sure not only that we don't spend more than our appropriation, that we also don't order goods in excess of our appropriation. And that's why we're going to use encumbrance. And we're going to review that, and then we'll be headlong into our Chapter 4 discussion. 4 Part 2 or 4B, whatever. Okay? All right, guys, so let's take the break right now, and we will reconvene. Let's make it 5:15 just to make sure we have time to get back. What time does this class get out?
6:20.
Good. That ought to be about perfect. Okay. Okay, guys, we're going to go ahead and get started back. And so we've understood that we debited estimated revenue. That was a debit that helped us to keep track of our actual revenue, which were credits. Our appropriations, we would credit those, and that's going to help us keep track against our spending. Our spending is going to be debits, right? Okay. Now, we run into the problem that what happens if we order so many goods that we have to pay for later that we accidentally exceed our appropriation because we over order. And I think I gave the example in here of the pink Lexus or something like that we ordered, and then what, we didn't have the money to pay the guy, and he was upset, and he's going to take us to court to make us pay him. Well, in that situation, the government would be compelled to exceed their appropriation, wouldn't they? So to guard against that, we use what we call an encumbrance system. Okay, and with the encumbrance system right here, when we order goods, we'll debit encumbrance, we'll credit budgetary control. That debit to encumbrance is going to sit as a placeholder against my actual expenditures when they come in, right? Okay, then what? When the actual expenditure comes in, the invoice comes in for whatever I've purchased, now what? Now I can debit budgetary control, credit encumbrance to remove that, because now I have the actual expenditure that I can replace with that estimate for the encumbrance, right? And I put in the actual expenditure. And remember, I said that we credit vouchers payable. Vouchers payable is just like accounts payable, but in government we call it voucher because we're going to have a voucher approval process where somebody signs off on those expenditures. So it's just a way of controlling. We call it vouchers payable. Okay? Now, we come over and notice what here? At the beginning of the year, right, and I have written up here, beginning of the year, we would have done what? We would have debited estimated revenue for $500,000, credit the appropriation for $400,000, credited budgetary control for $50,000, right? Okay, so we have an appropriation as a credit of $450,000. Then what? Then during the year, we go ahead and we debit encumbrances when we order stuff, and that debit against the credit shows that we only have $400,000 left of this appropriation that we can spend to purchase things, right? So if somebody runs in and says, hey, we want to purchase a piece of equipment that's worth $420, what do I have to tell them? No, we only have $400,000 left in the budget. They say, but I don't see any new equipment. Hey, we've ordered something worth $50,000, right? Okay, then what? Then that thing actually comes in, so what happens? I don't need the encumbrance anymore, so I credit the encumbrance, debit the budgetary control. That removes that entry, doesn't it? It reverses it, and now I put in the actual expenditure, and it's okay if the actual expenditure is a little different than what we estimated, as long as it's not some huge, amount that's different. And if it was, we'd have to fire our purchasing manager or whatever, right? Because it's like, what are you doing to us, right? And so what happens? We debit the actual expenditure. It was $500 more, and so now if somebody comes in and says, hey, well, I know we have $400,000 left. How about a piece of equipment for $400,000? We have to say, too late. The actual expenditure has come in now, and we only have $399, $500 left, right? Okay, so this provides us with budgetary control. Now, notice what? We sat here, and I just want you to see, remember I drew this as a little horse, this budgetary control. I said we put stuff on it, and then we take stuff off of it. Okay, and so what happens? That was a horse. See, this is the horse's head, and here's the body. Okay, these are the legs. Okay, so what happens? When we originally set up the budget at the beginning of the year, we did what? We credited the budgetary control, didn't we? Because we had a surplus. Then what? Then we ordered those goods, and when we did, we credited budgetary control again, didn't we? When the goods came in, we did what? We debited the budgetary control, and then at the end of the year, we reversed the original budgetary entry. We're going to always close out all of our budgetary entries at the end of the year. We debit the appropriation, we credit the estimated revenue now to close it all out, and we debit budgetary control for 50 now. Is budgetary control zero again? Is it zero again? Hello? Okay, so we set it up at the beginning of the year. We run our encumbrances through during the year. When the stuff comes in, we reverse the encumbrance out, and we close the budgetary accounts at the end of the year. So budgetary control is going to always end up at zero at the end of the year. I could ask you a question on your midterm in which I'll say to you, Budgetary control shows a balance of $50,000 at the end of the year. This represents, and the correct answer will be an accounting error. It's supposed to be what at the end of the year? 0. Okay? Okay, good. So that's what we're going to be going through, and we're going to talk and show journal entries both at the government-wide and the individual fund level now. And we're now officially in Chapter 4B, the second part, and we're going to be sitting here and looking at entries both at the government-wide level and at the individual fund level. Now, the book is using this dual-track accounting theory, and that they're thinking that governments would have accounting systems that would have 2 levels of accounting, and I've told you that's not how it works. They have 1 level of accounting. They account for things at the fund level, and then they convert the fund statements to what? To the government-wide statements. Did any of you get a chance? Was MGO at the thing? They were there? They were here? Anybody get a chance to talk to them? No? You did? What'd they say?
I just talked to one person, Eugene, and he said he's not in governmental anymore. But so I told him what you meant for this class.
Oh, okay, yeah. He's
And I talked to some interns or recently hired staff, and they said they do both commercial and governmental, and it's very interesting. That's all I know.
okay. Anyway, they're trying to make it sound like that. Yeah, okay, that's all right. Put this thing on pause. No, that's okay. Okay, I'll talk to. They didn't have Nancy, was it there? The recruiting person.
Don't know.
Okay.
They were quite busy when I was there.
Okay. Okay. All right. So what happens? We're sitting here and we're going to maybe have MGO talk to us at some point about, if they can, about how they would convert the fund statements to the government wide. Okay. But we're going to be looking at transactions at both levels here. Okay. All right. So again, we go ahead and we do what? We set up our budget at the beginning of the year. We're showing you that again. We debit the estimated revenue. We credit the appropriations. In this case, the estimated revenue is what? More than the appropriation, so we have a deficit, don't we? Okay. Okay, good. Now what happens? We go ahead and we're going to follow our encumbrance accounting, which is to debit encumbrance, credit budgetary control when we want to purchase this thing. Then what? Don't worry about the subsidiary ledger that they show us here, guys. I mean, I want you to know that there's a subsidiary ledger where we'd have detail as to what we were spending this money on, but we don't have to worry about that for this class. I just want you to know debit encumbrance, credit the budgetary control. That's when we order the goods, right? Then what happens? When the goods come in, we debit the budgetary control, credit the encumbrance for the original amount. That essentially wipes out that encumbrance entry, doesn't it? Closes it out, and then we debit expenditure, credit voucher payable for the actual amount, don't we? And as long as it's in the ballpark against our budget, we should be okay, right? Okay. Okay, good. Now you come over, and they showed us that at the government-wide level for our statement of activities, because we report our expenses by program, we would go ahead and debit expenses for whatever we were spending that money on. Remember, public safety was a program? Okay, so we're simply showing you what? At the government-wide level, we would call out our expenses by program, right? Okay, fund level, debit the expenditure, credit voucher payable. Government-wide level, we do what? Show it by program. Okay? All right. Come over, accounting for payroll. I do not care that you know how to account for FICA and federal tax payable and all that. We're not going to get into payroll accounting here. I do want you to know this highlighted starred thing here, which is telling us that what? We do not use encumbrances for reoccurring expenditures such as salaries. It is not necessary. What happens? Governments don't accidentally hire a bunch of people and then all of a sudden have to pay them, right? They know pretty much how many employees they have when they start the year, and so they appropriate enough to meet payroll, and if they know at the beginning of the year they're going to bring on additional people, they'll go ahead and set that up, right? If in the middle of the year they decide, well, we need to hire more people, then they'll appropriate that. It's not like all of a sudden someone sends in a time card to you and says, hey, pay me, right? You pretty much know that you had hired that person and you have appropriated the money you need to pay them. So if it's a recurring expenditure like payroll, like interest on debt, like the principal on debt, we know how much we owe. We know what the debt service is on that. We don't have to use encumbrance. It's for those things that come up during the year that we have to deal with. Oh, we need a new copy machine, whatever. That is where we use what? Encumbrance, right? Okay, not for recurring expenditures. Okay, now when we look at the payroll, the only thing I want you to know about payroll here, guys, is this, that we're going to sit there and set up our expenditure, and of course, some of the money is going to go to taxes, isn't it? And when some of the money goes to taxes, we don't call it taxes payable or Social Security payable or FICA. We call it due to federal government, due to state government. That's all I want you to know here, that we use this term, due to. When we owe money to another government, we don't call it payable. We call it what, everybody? Due to. Okay? If we owe another fund money, we call it due to. So we're not going to be calling these payables. We'll call them what? Due to, when we owe money to other governments, when we owe money to another fund. Okay? Okay, and then at the government-wide level, they call out their expenses again by program. So if these were police officers' salaries and fire salaries for $480,000, we'd classify that under what? Under public safety, right? Okay, and then again, we use what? Due to. Okay, okay, good. Now you come over and we have this notion of a tax anticipation note. Here's what happens. People are willing to lend the government money because they know that they can raise revenue at will through what? Taxing, right? Okay, and so they loan some money. It's a short-term loan, and since it's short-term, it does need to show up as a liability on my balance sheet for the governmental fund because we report our current liabilities, don't we? Okay, now, when we look at this example, this tax anticipation note was issued at a discount. How do I know it was issued at a discount? I received what? $297,000 of cash, and I'm going to have to pay back how much? $300,000. This tax anticipation note issued at a discount, didn't it? Okay, but what this government does is they set up the expenditure here because they know they're going to have to pay back that interest when the note comes due in, what is it, 3 months or something, or 2 months, 60 days? Okay, so this note was issued at a discount. Now, on the next slide, I don't fully agree with what the book put in, so I just wrote in what I want here. Since the note was issued at a discount, if we're at full accrual accounting, we go ahead and we set up that discount under full accrual accounting, just like you would in commercial, right? Debit the discount for the difference between the amount that you're ultimately going to have to pay back and the amount of cash you got. And then what? And then when we go ahead and we pay the note back, we will do what? We will, of course, have to pay them how much cash? We'll have to pay them back $3,000. I mean, $300,000. I should probably pay the principal too, right? So I'm going to debit the TAN payable for what? $300,000 and credit the cash. I forgot to pay back my principal on this. I got to pay back the principal, don't I? Nobody lets you borrow money from not making pay back the principal. So I got to pay that back, and then what? And then I just go ahead and recognize the, oh, hello. There it is. Okay, this was right there. They go ahead and they debit the what? Tax anticipation note payable, then credit the cash. What I had a problem with the book is they didn't show you the interest expense for the what difference between the amount you borrowed and what you ultimately paid back. That difference is a debit to interest expense and a credit to the discount, right? Right?
Would it be no payable or tan payable?
I don't know. Tan, okay. Feel better? Okay. That's fine. No, that's fine. Okay, tan payable. That's fine. Okay, when you see tan payable, okay. It's like this. Are you tan from the sun? Huh? Hi, I'm John from the earth. Okay, all right. Okay, all right. So you go ahead. That's one of my brother's dumb jokes. My brother's, he had like 1,000 dumb jokes. He'd always hit you with these dumb jokes. What did the here this is my brother's name is Herman, right? So he's got to tell dumb jokes with a name like Herman, right? Okay. So what did the pig say when the farmer grabbed him by the tail? What did the pig say when the farmer grabbed him by the tail? Well, that's what he said, but translated, what did he say? And from pig Latin to English, what did he say?
That's the end of me.
Yeah,
I remember this joke.
I told you this one before?
Yeah.
Oh, okay. Is this the end?
Managerial accounting.
Oh, okay. In what context did it have in managerial accounting? Do you know? You guys must have been falling asleep on me, just like you. Okay, okay. Very good that you remembered, though.
What was the answer?
This is the end of me. Okay. Every time I tell that joke, there's always like a slight delay in a way. I hear it, and then I hear it as the going across the room. I hear, oh. Okay, all right. As people get it. Okay, all right. So we're good here. Okay, okay, good. Now you come over, and we talk about inter-fund activity, and we're really talking about two types of inter-fund activity. Up here we have what? We have loans, don't we? Okay, and if we have a loan, what happens? If the, say, general fund is going to loan money over to who? Over to the capital project fund, what'll happen? In the general fund, we will debit loan receivable and credit the cash because we're sending them over cash, right? To lend them. In the what? Capital project fund, they will debit cash and they will credit what? Loan payable for this $10,000, right? Right? Whole thing happens on the balance sheet, and then eventually it's expected that that money will be paid back, right? And I'm not going to do the other side of the entry where what? Where now, the capital project fund debits the loan payable and credits the cash. The general fund debits the cash, credits the loan receivable. I'm not going to do that part. You understand that would happen, right? But this whole thing happens on what financial statement? The balance sheet, doesn't it? Okay. Now, if we have inter-fund transfers, okay, we call those non-reciprocal activity. And when it's a transfer, it's considered that the money will not be paid back. Okay. And so what happens? The receiving fund will record an other financing source, and the fund that is paying the money out will have an other financing use, won't they? So take the same situation now, $10,000 being transferred over from the general fund to the capital project fund, but now it was under the what? Idea not of a loan, but of a non-reciprocal transfer. What happens? We go ahead and we do what? In the general fund, we debit other financing uses, transfer out. Isn't that our one other financing use? We credit what? Cash for $10,000. Okay, now other financing uses is reported on the income statement, isn't it? Other financing uses on the income statement. Of course, cash is on the balance sheet. And then in the capital project fund, they will do what? They will debit cash and credit other financing sources, transfer in for $10,000, and you can see here that gets reported where? On the income statement. We talked about that last time, right? Right? Okay, general fund transfers the money out, debit other financing uses on the income statement, transfer out, credit cash, right? Is this money going to be paid back? This money is not going to be paid back. So what happens? We're reporting that on the operating statement, are we? In our other financing sources and uses section. Okay? Okay, good. Let's go ahead then and let's take a look at what happens when one fund is providing a service to another fund. Okay, so what happens? If we are being provided a service from, say, for water, water comes from the enterprise fund, doesn't it? Right? And so what's going to happen? In the general fund, we'll debit expenditure credit due to the internal service fund because we're going to owe them $5,000. Well, internal service fund or what? If it's water, it's the enterprise fund, but we're going to pay them for the water. Why does the city need to use water? What's that? Fire hydrant. Let's hope they don't have to use too much water for that purpose. But what? If there's a fire, they got to put it out. They pay the enterprise fund for that, don't they? So for the what? For the general fund, it's an expenditure. For the enterprise fund, it is a revenue, isn't it? Okay, and notice the account that is debited when one fund is going to be spending money, sending money over to another fund. We call that what? We call that due from. It is not accounts receivable. It is what? Due from, right? Right? Okay. Now, if it was the internal service fund that was providing a service, I don't know. Now the internal service fund is working on the police cars and the general fund's going to pay for that. What happens? General fund debits expenditure, credits what? Credits the due to or the cash, whatever. And then what? In the internal service fund, they're going to debit due to the general fund and credit what? Credit, again, revenue. This is what they do, isn't it? They provide services to the other funds, and they treat those as revenues. Okay? So we've had what? We've had three different situations where money went from one fund to the other. One was through a loan, entirely a balance sheet transaction. One was through a non-reciprocal transfer like what? Like a transfer in, transfer out. We showed the transfers in and out as other financial sources and uses on the statement of revenues, expenditures, and changes in fund balance. In other words, the income statement, right? And then what? Then we had where a service is being provided from one fund to another. For the spending fund, it is an expenditure. For the fund that's getting the service, for the fund that's providing the service, it is what? It is revenue. Okay? Okay, good. Come over and let's talk about encumbrances now of a prior year. Okay? And what happens? At the end of the year, what happens if we've ordered goods or services and we haven't received them yet? How should we handle that? Right? Remember we were saying that we receive the service, that we receive the goods and we reverse the encumbrance. What happens if at the end of the year we haven't received the goods yet? What should we do? Okay, so what I want you to do is take a look at that one of those two papers I gave you, and you should pick up right now the one that has the writing on it. You see something that looks like this in there on the paper? There's two of them. One has writing on it, the other doesn't. Everybody found that one? Okay. Now what this is sort of a comprehensive example that walks you through the entire process here, going from the recording of the entries to the beginning of the year, all the way through to the closing of everything at the end of the year. And so what you should be doing is you should be following along, looking, up here a little bit, but also kind of looking at your paper because it's kind of hard to see up here because this is kind of small. Okay, so that's why I gave you the handout. These same two files appear on this one and the other one that I gave you appear also on iLearn. Okay, I just posted those up there, so if you didn't see them before, you'll see them now. Okay, all right, so you go ahead and you take a look, and let's do with number one first. This government records the budget at the beginning of the year, so we debit estimated revenue, we credit appropriation, we credit budgetary control. We've seen that, right? We've seen how that entry works, the beginning of the year entry, right? Okay, so you come down, and all I'm doing here now and you can see it on your paper as well, is I'm setting up the appropriations ledger by crediting appropriation. And so the balance is a $1.8 million credit so that I know that I have this money available in the appropriation, right? Right? Okay. Now, I'm not going to do revenue. Revenue is not very interesting once we get past our revenue recognition rules because we sat there and we did what? We would have debited the estimated revenue and then we're just going to track against how our revenue comes in the whole year, right? Okay, so that's not that interesting once you've gotten past the revenue recognition rules. So I'm not going to do a revenues ledger here. But I am going to go ahead now and start to have my actual transactions. By the way, the highlighted yellow is the budgetary entries. The unhighlighted is the real, right? Those are my real accounts. And so I go ahead and I have my revenue. I debit cash. I credit revenue. Now, again, I would enter that in the revenues ledger, but I didn't put it here so this could all fit on one page. And it's very uninteresting. Debit estimated revenue, credit actual revenue. The balance is zero. We're done, right? Okay, so when again we would have to know our revenue recognition rules, of course. Now we've got this money, and so we now go ahead and we start to order stuff under our appropriation, and so we debit encumbrances, we credit budgetary control because we ordered stuff worth 1.4 million, right? And so we go ahead and we enter that debit into encumbrance in our appropriations ledger, right? For our encumbrance, 1.4 million. And what? We know that we have only 400,000 left on this appropriation to spend, right? Right? So if somebody runs in and says, "Hey, we want to buy something for 600,000," what do we tell them? No, because we don't have the budget authority for it, right? With me so far? Okay. Okay, good. Now what happens? Now we go ahead and 1.1 million of the equipment we ordered comes in as an actual cost of 1,300,000. So we ordered a total of 1.4. So far we've received 1.1 of what we ordered, but the cost is 1,300,000. Can the amount come in different than what we ordered it for? We saw that in the examples, didn't we? The amount comes in different than what we ordered it for. Okay, it happens, right? But we ordered what? A total of 1.4. So far from what we've ordered, we've only gotten 1.1 million, haven't we? So what do? We debit encumbrance 1.1 million, debit budgetary control 1.1 million right here. Okay, we do what? We credit the encumbrance 1.1 million because we received now that stuff that we ordered for the original amount 1.1 million, right? Right? Now when we do that, when we credit the encumbrance for a second, the budgetary authority comes up to what? 1.5 million here. But then what? Then we go ahead and we put in the actual expenditure here, don't we? We debit expenditure, we credit cash right here. Debit expenditure, credit cash. You come down and you put that expenditure into the appropriations ledger. And now we know we only have 200,000 left to go on this, right? And it makes sense that we only have 200,000 left to go because what? We started out with how much? With 1.8. We start out with 1.8. We just did what? We just spent 1.3. We still have what? We have this 500,000, but we still have 300,000 that still is going to come in from that original order because we originally ordered 1.4, and so far we've only gotten what? 1.1 of that amount, haven't we? So we still have 300,000 that's going to come. And so our what? Our appropriations ledger is doing a nice job of showing us what we have left in our budget authority, isn't it? We still have 200,000 that we can spend. We've spent 1.3 and we're still on the hook for what? For an additional 300,000 that's going to come in from that original order of 1.4, of which so far we've received what? 1.1. Okay. Okay, so how much did we order originally? Everybody? We ordered what? We ordered 1.4. Going back up. Going back up, we ordered how much? 1.4. How much of that has come in?
1.1.
1.1. And so we go ahead and we reverse only just the 1.1 part, right? Right there. We just only reverse the 1.1 part, and then we put the expenditure in for the actual amount, right? And so that used up essentially the extra 200,000 of budget authority that caused us to end up with only 200,000 left in our appropriation at the end, right? Hello? Question? Okay, good. Now you come over and let's just analyze our budgetary control over here. Let's not yet. Come over and let's do our closing entries. So now we're to the end of the year. We still have what? 300,000 of that total 1.4 that we ordered that hasn't come in yet. This is the encumbrance that's still outstanding at the end of the year, so we're going to deal with that as part of our closing. Okay, but let's just go ahead. Let's do our closing entries, and we're going to close our real accounts. We're going to debit revenue, credit expenditures. Is that how you close accounts? Is that how you close accounts in Accounting 100? You debit revenue, you credit expenditure, you credit the unassigned fund balance for 700,000 because that's like retained earnings, right? Is that like retained earnings? So you credit the unassigned? Okay. Then what? Then you go ahead and you close that outstanding encumbrance. Remember, our encumbrances were still outstanding at 300,000. We had originally set it up for what? 1.4. We reversed out 1.1. So there was still 300,000 sitting in the encumbrance account, wasn't there? So I want to close that out. So I debit budgetary control. I credit encumbrance. That closes out my encumbrance account. And then I go ahead and do what? I go ahead and I set up, I close, I should say, right here. I set up, I don't close, but I set up my unassigned fund balance. I take 300,000 out of it, and I set up my assigned fund balance because I'm on the hook for that money, right? And so I have to show the constraint on my fund balance, right? I got to pay those guys, so I go ahead and I set up the unassigned fund balance, and then I go ahead and I close my budgetary accounts from the beginning of the year. I simply close those. I'm simply doing what? I'm simply sitting here and reversing that original entry. I just reverse it, right, by year end. So it gets reversed out, and so I'm sitting here now. That's all zero. And then I determine that I want to put, and this government decides, well, you know what? That 200,000 of budget authority that we haven't used up yet, of the appropriation that we haven't decided how we're going to use it yet, we're going to go ahead and we're going to mark that as committed. That's committed for some purpose. And I just wanted to remind you here by showing you the committed that there is this situation where we would go ahead and potentially commit some fund balance. And so we go ahead and debit the unassigned fund balance and credit the committed fund balance for that remaining 200,000. Okay. Now, you take a look and let's go ahead and let's pull the financial statements. Okay. And so you come back up, and didn't we have revenues of $2 million? Right? There's my revenue, $2 million, less my expenses of 1.3. So I have a change in fund balance of $700,000, right? Okay, which we saw that got close to my unassigned fund balance, didn't it? Okay, then what? Then I go ahead and I prepare my balance sheet, and when I prepare my balance sheet, I have cash of 700,000. How did I get cash to 700,000? The 2 million that I originally got when I got my revenue minus what? 1,300,000 that I've spent on equipment now. That's how I got the 700,000 cash there, right? Okay. I have my liabilities are zero, and then my fund balance, we originally did what? We originally sat there and set up the fund balance unassigned 700,000, but then we had to show that we had some that was assigned for the encumbrances, that 300,000, right? So when we debited the unassigned, we credited the assigned. That brought down the unassigned by 300,000. So we were left with what? With 400,000 at that point. And we did what? We credited the assigned to put that into the assigned right there. And right, this journal entry right here. Okay, and then what? Then we went ahead, and I'm just telling you, we decided to commit 200,000 of the fund balance. And so when we took that 200,000 out, we were left with what? We were left with this 200,000 that was unassigned, and the 200,000 of the unassigned is the surplus, isn't it? 2 million of revenue minus the 1.8 million that we've decided that we're going to have what? Have appropriated. That means we'd have 200,000 left over that is unassigned, isn't it? The 200,000 that we have committed is money that came from what? Came from, say, the 2014 in this example, from our 2014 budget, didn't it? And we've just gone ahead and said, hey, we're going to commit that for amounts that only relate to potential 2014 expenditure, or however we committed. I don't care. I just want you to know that we're committing that amount, right? So that's how we ended up with what? With this amount that is in our fund balance, the unassigned 200,000, the assigned 300,000 for the encumbrance, and what? The committed 200,000. Okay? So what happens? Everything here gets closed at the end of the year, doesn't it? Except my balance sheet accounts. Okay? Okay, so go back through this now. What happens? We sat here. We set up our budget at the beginning of the year, didn't we? We debited our estimated revenue. We credited our appropriation. We credited what? Budgetary control. I'm just going back to step one. We put that money and we put it into our appropriations ledger, and we put it in there for 1.8 million of credit, right? Then we went ahead and we got some revenue. We debited cash. We credited the revenue. We got some cash, right? Then we went ahead and appropriated, not appropriated, but encumbered some of that appropriation, right? So we debited the encumbrances, 1.4 million. Just go ahead and tee up encumbrances over here. Did I do that over here? Yeah, there was my debit to encumbrance, 1.4 million. I debited encumbrance, 1.4 million, right? Okay, and I credited budgetary control. Now notice my buddy budgetary control down here had the original 200,000. That's that 200,000 there, plus the 1.4, so he's up to 1.6 million right now, right? Right? Okay, then what happens? Then I go ahead and I get 1,100,000 of the original amount that I had encumbered for 1.4. I get 1,100,000 of that, but it comes in an actual price of 1.3 million, right? So I reverse the encumbrance for the original amount. I go ahead and I stick that into the appropriations ledger. When I do, for a split second, it comes up to 1.5 when I credit that appropriation right there. But then what? Then I replace it with the actual amount of the expenditure, and when I do, that what? That brings me back down to this 200,000, right? Okay. Notice that in my encumbrance account, since I credited 1.1 million, they're sitting there showing me that I still have what? A balance of this 300,000 at that point before I make my closing entries, right? I still have a balance of 300,000, 1.4 versus 1.1. I still have a balance of 300,000, right? Then what? Then I go ahead, I come to the end of the year, and I'm going to close all of my close everything. So I'm going to do what? I'm going to debit my revenue, credit my expenditure, credit the unassigned fund balance, just like you would in commercial to close those. I closed the remaining encumbrance. There was 300,000 left in there, wasn't there? So I closed that by debiting budgetary control and crediting encumbrance. And when you take a look now, there's where that 300,000 was coming from. So my encumbrance is now 0, isn't it? Isn't it now 0? I close it out to 0. I come back over. I come back over. I debit my budgetary control for the 300,000, and notice my budgetary control would had 1.6 in it, but then when the 1.1 came in, I debited my budgetary control. I credited my encumbrance. There's 500,000 left. And since I just debited budgetary control when I credited the encumbrance, now there's only what? Now there's only 200,000 left, right? In my budgetary control? Okay, and then what? Then I go ahead and I come back down and I decide that I'm going to close. I have to close my budgetary accounts from the beginning of the year. So I debit the appropriation, credit the estimated revenue. I debit budgetary control, and when I debit my budgetary control, is it now 0? So it is 0. The encumbrances are 0. The revenues are 0. The appropriations are 0. The expenditures are 0. All of my proprietary accounts got closed. All my budgetary accounts got closed, didn't they? Everything is 0 except obviously my balance sheet accounts. And again, I had decided to commit some of my unassigned fund balance there for 200,000. I made that entry, and now I have my balance sheet. I have my income statement, right? And you can see how we got to the unassigned, the original credit for 7, and then the debit for 3, the debit for 2 when I closed my encumbrances and when I closed my budgetary accounts, and I should say when I committed that, when I set up my assigned fund balance and when I set up my committed fund balance right there. And that's how I ended up with the 200,000. Okay. Question? Question? Okay. All right. So if there's no questions, then let's see if we can start looking at we're going to do that inventory one later. We'll do it next time. Let's see. Keep that other piece of paper. Bring that other piece of paper. Keep them both. Bring that other piece of paper next time. Okay. So let me see. Hang on. Let's see here. How do I want to do this? I think I want to close this. Thought I did already. And I can get rid of this now. Okay. And let's go into Chapter 4B quiz. I think I was trying to guide the satellite back from outer space as long as this thing's taking to go through. Is that space lab supposed to crash anytime soon? Thing's going to crash before this thing opens. Okay. All right. So let's go ahead and I don't know. I don't want this. Okay. So let's go ahead and let's take a look at a couple questions then, okay? And I'm going to go ahead and see how far I can get you in this homework, and then you go ahead and you finish it yourself, and we'll start it next time as we are in our final prep for our exam, right? Okay? Okay, so let's just go ahead and let's take a look, and we'll start with this next time. And I'm going to see how far we can get now, and then we will continue on with this next time. I guess I don't know what I want here. Okay, that's good. That's probably too thick though. I'll use a thin red.
This isn't online, right?
It's not?
Yep.
Okay, well it will be. You want it? You want it now? Ma, I want the meatloaf. We want it now. Okay. Just a second. So I'll go ahead and I'll give it to you now. Let me do this real quick. We don't need to sit here and have this whole thing go. Should be up there now that you can look at it. But let's just take a look at this file. And this City of Kent's Police Department needs a new police car. The police car is ordered at an estimated cost of $34,000. So what happens? When we order the goods, we do what? We debit the encumbrance, we credit the budgetary control for $34,000. When the car is received, the actual cost is $35,000. Which of the following is part of the budgetary entry that should be made when the car is received? And the answer is what? Credit encumbrances for $34,000. When you order the goods, you do what? Debit encumbrances, $34,000. Credit budgetary control, $34,000, right? When the car is received, you debit encumbrances for $30,000. What did I do? Write it twice here. When the car is received, you debit the encumbrance. When the car is ordered, you debit encumbrances, you credit budgetary control. When the car is received, you do what? Debit budgetary control for the original amount, right? $34,000. Credit the encumbrance, and then debit expenditure and credit what? Credit the voucher payable for the actual amount, don't you? Okay, and so what happens? You take a look here, and we say, when this car is received, did we credit encumbrance for $34,000? So some reason we have the same question twice here is all I can see. But we credit the encumbrance for $34,000, right? Right? Okay, good. Which of the following is not a character classification? I think this was actually chapter 2, wasn't it? Chapter 2. Okay, character talks about what? Talks about the period of benefit, doesn't it? Character, and we have what? Current, or we could have capital outlay, we could have debt service. Activity is what? Not a character classification. Okay. All right, come down, and it might not. It's probably not a bad idea here. Where's that coming from? Oh yeah, for question 4, let's take a look. A governmental entity uses encumbrance accounting. During the year, the government ordered but had not yet received a new police car. What effect will these events have on the unassigned fund balance? And we're saying the balance in this account will be decreased. Okay, so what happens? Notice here we went ahead and when we ordered, let's say we ordered 2 police cars. Okay, and each one cost $45,000, and let's say we had appropriation of what? Of $100,000. We would have credited appropriation for what? For $100,000. We would have debited our estimated revenue, and if we had a surplus, we would have credited our budgetary control, we would have debited our budgetary control. But we have this 100,000 of appropriation. When we ordered the police cars, and we ordered it for, say, I want to order what I guess. What am I trying to do with this example? Let's say I order 2 of them, and each one I'm thinking is 22,500. No, that's not going to work either, John. You give me an order. Oh, I see. Okay, I got it. So I have 100,000 of appropriation, right? I order a police car, and what happens? The original amount that I order it for is 45,000, right? And so when I do, what happens? My budgetary balance here is 55,000, right? Then what happens? Then I go ahead and the police car. What am I doing here? What on earth happened here? This isn't making any sense to me now. 55,000 is left. No kidding, this is not asked because this thing doesn't make any sense. I'm erasing this. I don't know what I was trying to do. Can I erase it? Yeah. I don't know what I was trying to do. Let me start over here. I can't make sense of my own notes. I guess they made sense at one time. Okay, but come over. Let's just do an actual numeric entry here. Government uses encumbrance accounting. During the year, the government had ordered but not yet received a new police car. Okay, so I order the police car. I debit my encumbrances. And let's say I order it for, I'm just going to stick with those numbers I had before, 55,000. And I credit what? Bud control, right? Okay, good. For 55,000. So by the end of the year, that thing hasn't come in yet, has it? Okay, so if it hasn't come in yet by the end of the year, what do I need to do? I debit my Bud control for how much? 55,000, and I credit the encumbrance because I have to close the encumbrance account, don't I? For 55,000. But now I have to set up the fund balance that it now is going to be assigned for that encumbrance that hasn't come in yet, right? Okay, and so what do? I go ahead and I debit the unassigned fund balance for 55,000, and I credit what? Assigned fund balance for 55,000, just like I did for that whatever it was 300,000 that hadn't come in yet on the other example that we just looked at. But it does do what? It does decrease the fund balance, doesn't it? Right? The unassigned fund balance? Okay, so again, we order the goods. At the end of the year, the goods hadn't come in. You still have to close the encumbrance as though the goods came in, don't you? And then you have to set up the assigned fund balance by taking them out of the unassigned and putting it into what? Assigned. So now someone knows that that money isn't available for free spending. It's got to be used to what? To cover that encumbrance of those things that are going to come in, right? Okay. Okay, I don't know why I had written all that other stuff up there because it doesn't make any sense now. Okay. All right. Take a look at this one. Public school district budgeted estimated revenues of 800,000, appropriations of 780. Which of the following is the appropriate entry to record the budget? I do what? Debit estimated revenue, credit appropriation, credit what? Budgetary control for the surplus, right? Okay. Okay, good. Number 6, a county general fund. Here we go again. Okay, with one of these, I think that makes sense now. The what? The county general fund budget included budgeted revenue of 900,000 and budgeted expenditures of 890. actual revenues for the year were 950. To close the estimated revenue account at the end of the year, and all I did here, guys, was I set up what? This is the beginning of the year. And at the end of the year, I did what? I simply reversed that to close it, don't I? For the original amounts. And so isn't there a credit to estimated revenue to close that right there? Right? Okay. Okay, good. Number 7. Carolina City places an order for a specific item of equipment and encumbers $6,000 for the item. The equipment arrives with an invoice of $5,700. Which of the following entries should be made? And let's just go through and, oh, that's what I have up here. Is that the entries? So I showed you the entries right here for this fact pattern. So I do what? I debit encumbrances, I credit budgetary control when I order the stuff, don't I? Right? When the stuff comes in, what do? I reverse debit budgetary control for 6,000, credit encumbrance for 6,000, and I credit expenditure and debit expenditure and credit voucher payable for the actual. So is it true that I have a debit to expenditure of 5,700, a debit to budgetary control of 6,000, and a credit to, they're calling it accounts payable, okay, 5,700, and a credit to encumbrance for 6,000? Isn't that what just happened up there? Right? Okay. Okay, good. Number 8. Let's do one more. Whatever the next number is. What is it, 9 or 8? 8. Number 8. Oh, good. We didn't do inventory yet. Okay, so that's good. Let's just stop right there. Okay, good, because we'll get to these inventory things next time. Okay, so you don't have to worry about 8 and 9 because we didn't get to inventory. Hang on. 8 and 9. Hang on, guys. We'll get to inventory next time. So 8 and 9 is inventory. Hang on. Yeah, number 10 you should be able to work. Number 11 is a detailed problem, even though we're only going to have multiple choice questions on the exam. So you should be able to work through. So that's your major 11, 12. So other than those two that I said don't work on the inventory, you should be able to work the rest of these. So you should be ready to come in to work the rest of these next time so we can go through them, look at the inventory stuff. We'll come back and work those couple of inventory questions, and by then I'll have a whole new set of questions, about 30 of them up on iLearn, and we'll spend the rest of the time going through a whole new set of questions to get ourselves ready for the test, all right? Okay, guys. See you on Thursday.